Neha Singh. I'm the founder of Womoneysta, and today is a very special session because gold prices have, they've surpassed, I think, everybody's expectation. Every time we do a session on gold, it's at a time where everybody's questioning, will it go any further? When it was about to touch 75,000 sometime back, we did a session. Then it was about to touch 1 lakh, we did a session. Now we're at a point where we are way beyond 1 lakh and 1.2. So every opportunity this beautiful commodity is giving us to invest, we are wondering, what more can we do? So for this, today we have a very, very special partner who's come in. We have Sheila and Ghazal who are joining us from the World Gold Council. Now, about the World Gold Council, it's one of the world's best known research firms which can give you the latest, the most updated, immaculate research about whatever is happening with gold. Talking of our two speakers today, I think I will just take a second to introduce both of them. We are in August company because I will jump right into our speakers today. Sheila has more than 20 years of experience in the financial services and public policy domain. She currently works with World Gold Council. She joined in 2016. She's also worked with organizations like DSP. She's worked with Standard Chartered. Ghazal comes with 7 years of experience in financial services, and she's worked with Quantum Mutual Fund, especially with the gold fund of funds and the gold ETF. So I think we are in great hands today to learn so much about what this commodity and what overall the role it has in our portfolio. Thank you, Sheila and Ghazal, for doing this for our community. It's totally a pleasure for us to have you here. What are the things that we can expect to cover in today's discussion? So what's in it for me today? Why are we seeing these crazy gold prices? What's the lesson that we can learn from history around this? What are the special scenarios that gold has, when it comes to interest rates, inflation, rupee depreciation? How much gold should I actually be holding in my portfolio, and what are the different strategies and formats in which I should have them? Over to you, ladies, now to share with them everything they would love to know about how gold is working, what are the formats they can use. So thank you so much for taking out the time and doing this for our community.
Thank you, Neha. Thank you, Ishika. Interesting pointers in the poll there. If you actually add gold ETFs and gold funds, it comes to about 27%. So I would say it's not bad at all. Whilst the jewelry is, the popular, go-to for anything to do with gold, I think we are seeing a change, and it's change for the good. But without much ado, I'll start my presentation. So thank you again, everybody, for joining this. And I do hope we don't disappoint you and that you can go back, learning a lot more than what you already know. For those of you who don't know who we are and what we do, we are a membership-driven organization founded by some of the world's largest gold mining companies. And we produce a lot of data, like Neha has said. We produce a lot of research and insights that actually help people understand the role of gold in portfolios. And we also work with policymakers and the industry in general to help set standards for a perpetual and sustainable, gold market. Now, coming to what gold has been doing in the past couple of years, we all know that 2024 was a great year. In terms of performance, gold outperformed most asset classes across almost all currencies in the world, giving returns in excess of over 25%. Even if you compare it with US stocks, emerging market stocks, bonds, cash, or other commodities as well. 2025 started off a little differently. We saw gold actually surging, and then after April, it kind of, tapered a bit. It went quiet. But again, in the last couple of weeks, we are seeing gold power ahead. Couple of days ago, gold crossed $4,000 per ounce. And if you look at returns, again, this year has been a great year so far. Sorry. Gold has given returns in excess of 40%, clearly exceeding all other asset classes for now. If you look at October 7th, I mentioned earlier that gold crossed 4,000. So this data is a bit outdated, I would say, because this is as of 7th. Yesterday was the 8th and it did cross 4,000. So on the 7th, we were at about $3,900 per ounce. But that mark has also already been breached. Now, if you look at gold, it's a scarce asset. You don't have so much gold available in the world, but the financial market for gold is very large. In terms of jewelry, obviously, the amount of gold that is available over ground, jewelry takes, the highest number, which is about 97,000 tons. Bars and coins, in terms of their availability and above ground stocks, we are at about 48,000 tons. Central banks have also been consistently buying gold, and their stocks are at about 37,000 tons, 37,000 plus, including RBI. RBI was one of the largest buyers last year, where it bought over 75 tons of gold. Proven reserves, which is gold that is underground but yet to be mined, is at about 59,000 tons. And the other stocks, which is mentioned here at about 32,000 tons, is all the gold that gets utilized in electronics, industrial uses, technology, all your phones, laptops, some modern devices like even vacuum cleaners. All of it have actually got gold. I'll now hand it over to Ghazal, who will take the next few slides. Over to you, Ghazal.
Thanks, Sheila. So guys, well, the headlines are definitely, all about the gold price rally and, which of course has been nothing short of remarkable. If we step away from the noise and dive deeper into gold as an asset class, we can talk about the when, the where, and the why of gold demand, because ultimately that's what influences prices. And when we understand this, we can take more informed investment decisions. So, as you can see on this slide, typically gold has, 4 drivers. We have bucketed them as strategic and tactical. So first, addressing the strategic drivers. In periods of economic growth, we see that, people have higher disposable incomes and they tend to do higher expenditure on items like jewelry, which in turn drives consumption demand for gold. The second strategic factor would be risk and uncertainty. In this case, on the flip side, when the economy is not doing well, or, there are certain risks on the horizons, investors prefer the stability that gold, as an asset class can bring to the portfolio. Now, this drives investment demand for gold in such periods. Coming to the tactical drivers, number one is, of course, opportunity cost. That is when other asset classes are yielding better returns than gold or lower returns than gold. That definitely influences investor attitudes towards gold. For instance, the interest rate that we receive on bonds. If that is lower than the returns that gold can potentially yield, we see flows or money get diverted towards gold and vice versa. And lastly is momentum. Right now we're seeing a very strong momentum in prices, and when that happens, it can really attract more and more investors to come in, which in turn becomes a driver for gold prices. Moving on. So yes, it is true that we Indians love gold, but we're not the only ones. As you can see, gold is a global market with 71% of global gold demand coming from emerging markets like China, India, and Southeast Asia, and 29% coming from developed markets. And if we look at, gold's average annual net demand, on the next slide, we see that, about 3,100 tons approximately. That's the kind of demand we see for gold on an average annually. Um, and if we see segment wise, we find that 33% of the demand comes from jewelry, 7% from technological applications, like Sheila mentioned, in mobile phones, laptops, and of course, emerging technologies. 40% of global gold demand comes from investment demand. This includes gold bars, gold coins, and gold investment products. And 20% of global gold demand comes from central banks. So, of course, jewelry and technology demand is stronger in periods of economic expansion, whereas investment demand, kind of takes the lead when there is, risk and uncertainty in the macroeconomic or geopolitical environment. So over the last few years, if we look at these factors, last few quarters, central bank demand and investment demand have, been stronger given the macroeconomic and geopolitical uncertainties that we're seeing globally. Whereas demand for physical gold or jewelry has been softer on account of the higher prices and the economic growth moderation, that we've been seeing. So yeah, with that, over to you, Sheila, again.
Sorry. So let us look at, what are the key barriers to investing in gold? Why do we think that gold is a strategic asset? And what are the common perceptions that typical investors think when it comes to gold? So what happens is a lot of people think that gold is mainly a tactical hedge. It's not a strategic hedge. It's also probably not very different from other commodities, whether it's copper, aluminum, or the platinum group of metals, or even silver. And the perception is also that there are better ways to protect against inflation. And because it doesn't give you a dividend, or it doesn't give you a yield through interest, it only preserves capital. So what really is the role of gold in a portfolio, and why actually have gold at all in a portfolio? So if you do a little bit of analysis there, gold basically can enhance portfolios in three ways. One is that it provides liquidity. It's an extremely liquid asset. We will see in subsequent slides, why I say this. It's also a good diversifier, because in any portfolio, you can't obviously have all your eggs in the same basket. You would need to diversify, just so as to minimize the risk that you would have otherwise. And also, if it really gives returns. So let's take a look. Now, we've done some analysis over multiple time horizons ranging from 1 year to 15 years. And we've compared gold with various other asset classes, such as equities, Indian government bonds, corporate bonds, and even T-bills. And what we've seen is that gold actually gives good returns over multiple time horizons, ranging anywhere between 10 to 20%. Similarly, if you look at the returns in periods of high inflation, typically what happens is your purchasing power gets eroded. Your currency actually is devalued. And the role of gold at such times becomes more important, because inflation, you need an asset class that gives you inflation adjusted returns or inflation beating returns. And we've seen that in periods of high inflation, or whether it's through when there are periods where money supply is increased, gold actually has performed well. If you look at volatility, any asset class that minimizes volatility will always stabilize your portfolio. And we've seen in more recent times, even as recent as from last November onwards, when there was a change in the US government, how the equity markets in India have been behaving. They've been up one day, down the next, mostly, on the lower side till at least March. And markets have been very volatile. We compare gold with emerging market stocks, commodities, developed market stocks, even if you compare it with asset classes such as private equity and REITs, gold is definitely less volatile. And therefore, we think any portfolio that is not very volatile, it makes sense to have an asset class that reduces volatility. Coming to diversification, like I mentioned earlier, you need an asset class that balances out performance, that gives you good risk adjusted returns. And good diversifiers are hard to find, because when the going is good, if all asset classes behave exactly like each other, it's okay. But you need a diversifier more so when the markets are actually not great, or when everything around you is collapsing. And what we've seen is that gold actually does exactly that. What do I mean by this? When the markets are good, gold does well. But when markets actually fall, gold does better. Why? Because gold is not correlated to equities in any way. It's not related to policy measures and policy announcements, and therefore it becomes an asset class where it's considered to be a safe haven asset. So you need a diversifier like gold in portfolios, uh, especially when markets are not doing well. In the past few years, what we've also seen is um, correlation between equities and bonds has turned positive. So you definitely need an asset class that doesn't behave like equities and bonds, and that asset class is gold. So we've also compared gold's performance with Indian bonds, and we've seen it similar. And simply because in the past few years, correlation between equities and bonds has turned positive. Now, if you look at diversification, we've done an analysis from the mid-90s, when we had the Gulf War, the 9/11 bombings in the US, Brexit, the recent Russia-Ukraine invasion, or the Israel-Hamas, crisis that has happened since the last 2 years. And in all these periods, whenever there is a geopolitical event, gold actually tends to go up. Likewise, in periods of systemic risk, here again, we've looked at the mid-90s, where we had the LTCM crisis, the dot-com bubble of the 2000s, or the 9/11 crisis, the recession, sovereign debt crisis, Brexit, COVID, and the pullback after COVID. In all these periods also, where global stocks or treasuries, and this applies even to Indian stocks and Indian bonds, we've seen that actually gold performs well. Recovery periods after a sell-off, again, is a good period for gold to perform well. And if you look at liquidity, which I mentioned a few minutes ago, gold is an extremely liquid asset. If you compare it with Indian bonds, Indian equities, the T-bills, or even any other asset class, the amount of gold that gets traded every day is in excess of $200 billion. No other asset class gets traded so much, and apart from the S&P 500. So it's an extremely liquid asset. What does this mean? It means that basically when you want money, you can sell gold and you will find a buyer. It cannot happen that you will not find a buyer for gold, because it is a liquid asset. It's a universal asset available globally. It's not dependent on the vagaries and the whims of a particular policymaker or a particular government. So coming to key risks, I think what's also important to understand is that whilst there are opportunities when it comes to investing in gold, gold does not conform to standard valuation methodologies that can be used for equities and bonds. It doesn't provide you a regular income. Equities will give you dividend, like I said earlier, and fixed income products give you a coupon or an interest. But it still is a good diversifier because it behaves differently than these two asset classes. Over to you, Ghazal.
I'll take it from here, Sheila.
Yeah.
So Sheila has taken us through goals, return enhancing and risk reducing qualities. Now, let's take this discussion further by testing goals' impact on a portfolio. So if you look at the next slide, we took a portfolio with a 70-30 equity fixed income allocation. and we plotted its average risk-adjusted returns on the graph on the right. Risk-adjusted returns here mean annualized returns divided by annualized volatility. And over a 20-year period ending December 2024, we see that the 70-30 equity debt portfolio, its risk-adjusted return was somewhere between 0.8 and 0.85, the bottom left dot on the graph, if you can see. Next, we started adding gold to this portfolio. First, an allocation of 7.5%, then 10%, and so on till 15%. And we observed that the risk-adjusted returns of a portfolio with gold actually improved, as you can see on the graph with the line going up. Coming to the next slide. So here's the same data in a tabular format. So if you see, the first row, as we keep adding gold to the 70-30 equity debt portfolio, the returns pretty much stay the same, ranging between 11.2% for the equity debt portfolio to 11.6% in the portfolio that has 15% gold. Similarly, if you look at the volatility, it has gone down from 13.5% for the typical equity debt portfolio to 11.4% in a portfolio with gold. And even the drawdowns, if you see, are, come down from minus 37% to just 29%. So overall, over, this 20-year period that we've, run this data on, investors with a diversified portfolio would have benefited from including gold in their portfolio from a return as well as volatility as well as a drawdown perspective. However, when we ran this model, a gold allocation over 15% actually, hurt returns without meaningfully bringing down the risk, thus suggesting that up to 15% portfolio allocation to gold is optimal. Coming to how we can invest in gold, there are various ways to take exposure to gold. So if the use is for consumption purposes, such as adornment for weddings, gold jewelry is the way to go, definitely. I don't need to tell you that. But if investment is the purpose, gold bars, gold coins, gold-backed products like gold ETFs can also be a good way to take exposure. Gold ETFs are, in a sense, mutual funds that invest in gold, and their objective is to mirror gold returns and pass them on to investors. But they also trade on exchanges like stocks. So yes, by taking exposure through such gold-backed products, investors won't have to worry about the purity of gold or its storage, and it can thus be a smart way to add gold to your portfolio. On that note, back to you, Sheila.
So if you look at recent performance and outlook, in terms of where we are now, gold has hit, obviously, we all know this, that it has hit all-time highs this year as well as last year. One of the main drivers for this has been risk and uncertainty. The risk and uncertainty is primarily because of geopolitical wars, whether it's Russia, Ukraine, Israel, Hamas, but also economic concerns from the US that have affected most parts of the world. What do I mean by this? Ever since Trump has become president, every second day he announces, some tariffs on some country or the other. And as a result, there's a lot of uncertainty in not just in the US, but in other parts of the world as well. Tariffs obviously are not going to mean good for the markets where he imposes tariffs, but also to the US, because the cost of producing anything in the US itself is going to be very high. The other thing is, we've seen that Trump wants to bring down interest rates very drastically and very quickly. He is not the person who is supposed to influence this decision. The Fed is, the authority on it, and they are supposed to be autonomous. But obviously, he doesn't want to, give Fed that autonomy. So where do you think we will go from here? There are 2-3 things again. Emerging market gold buyers like China have actually stepped back What do I mean by this? They're buying fewer jewelry. Even India, for that matter, jewelry consumption has come down if you compare it versus the last few years. Why? Because the prices are so high and people are not going to be able to spend additional money to buy the same amount of gold. So if they have a budget of, say, 1 lakh rupees for a wedding, they will still buy that much, that amount of gold, but the quantum is going to be much lower because the prices have gone up. The last 3 years, we've also seen central banks, including RBI, consistently buy gold, and the total central bank buying on an average until 2024 has been at least 1,000 tons. We are seeing a slowdown there. Again, the reason for this could be prices. But on the other hand, what has happened is Western investors who have stayed away from buying gold, whether it's bars, coins, or ETFs, have come back. We saw that starting somewhere last year, but this year we've seen more of these investors come in. And although the retail bar and coin demand is still sluggish, we are seeing ETF demand grow. And the other thing that is happening is, if central banks step up their gold purchases, if that happens, probably yes, when the prices come down a bit, they may up their purchases. But we think they may not buy the same quantum that they bought the last 3 years. So the total central bank purchases may be only about 850 to 900 tons, not 1,000 tons for sure. The other thing is, there has been a development in China where they've started a pilot with about 10 insurance companies, and these 10 insurance companies have been permitted to buy gold in their balance sheets, which is a big thing because China has about 250 insurance companies, and if this pilot goes well, we will see demand from insurance companies in China also grow. So, we think gold still has potential to do well, mainly because Western investors have just started their buying, and we think they will continue to buy. Emerging markets, the jewelry demand is definitely going to be lower, but investment demand is picking up. Even in India, for example, investment demand, whether it's through bars, coins, and ETFs, has been increasing. We've had, we've just released our numbers for September, and we've seen that India alone now has about 77 tons in ETFs from all accounted for, so far between about 22 ETFs together. So has gold reached its peak? We are not able to comment on the prices, but honestly, even in the past, when we thought gold has reached its peak, it still continued to do well. And we still think there is room here because simply because of what's happening in the US. If Trump takes away the autonomy of the Fed and brings in a new Fed chair, the new Fed's chair's agenda is going to reduce interest rates drastically. And we see scope for gold doing well when that happens. And we think that will happen sometime middle of next year. But until then, investment demand continues to grow because a lot of high net worth individuals who have stayed away from the markets, especially in the Western and the US and the European markets, are now coming back.
I wanted to share something with everybody in the room. So, of course, for many people here who are coming in for the first time, just a little bit about Womoneysta. We've been running sessions on learning for women to get better with handling money on their own. So we do have courses specifically on the website, which are around gold investments, ETFs, because typically now gold and ETFs are being spoken about together. So you can consider picking up these. More interestingly, if you enjoyed the session today, please join our WhatsApp community if you're still not on it, or share it with your lady friends who can be part of more such sessions. And since Ghazal talked about investments, I am also going to share a little activity that we are planning on Dhanteras, which is on the 18th of October. And we like to call it the Invest Together Day. It's an auspicious occasion. Most of us will be going out and buying something precious that day. And if gold is on your mind, And if you want to start exploring the idea of gold mutual funds, please feel free to join in. It'll be a quick session like this online. Our team will come in, share options, explain to you what a gold mutual fund or what a gold ETF is like, and we'll actually do the action of investing together. Something not just auspicious, but special to do together. So you will, if you join the WhatsApp community, we're going to be sending all the details on the community. Scan the code if you're still not on it. Very soon you will get details. So I'm really excited to do this. We've done this earlier, and it's always so much fun where all of us come together from different parts of the world, spend that 1 hour together, and actually take that action, right? So I just picked up Ghazal's point. You don't have to start big. You can start with a very small amount and do this activity together.